day friends. In the subject of personal financial planning, in our lecture series on risk and return, I will be talking about today measurement of systematic risk. In my previous lectures on risk and return, we talked about what is return, how do you calculate return, what are the different types of return which you get by investing in asset, means realized return, expected return, holding period return, and how do you calculate the return. And in the risk, we talked about systematic risk, unsystematic risk, methods of measuring risk. If you recollect, in my previous lecture, I talked about 4 methods of calculating risk. That is basically the range, standard deviation, variance, coefficient of variance. These were the different issues, these different methods which we talked about in the previous lecture on measurement of risk. And those measures which we talked in my previous lecture, that is range, standard deviation, variance, coefficient of variation, these were all to measure the total risk. As you are well aware by now that there are 2 types of risk involved, the systematic and non-systematic. So these methods which we discussed in our previous class, they were basically methods of measuring total risk. If you want to measure the systematic risk involved in an asset or involved in an equity, the beta is a very good and popular method of measuring the risk. Whenever we talk of systematic risk, the first method of measuring that risk comes in our mind is called the beta. Just to explain you in a very simple language, that when you talk of beta of an asset, beta of an equity, right? If I talk in terms of a particular share, that is, you want to know that what is the beta involved in this security. What we mean by beta? That average return of an equity market, if I talk of equity, right? So what is the average return or return of the market is by and large being calculated or being measured in terms of the Nifty return or the Sensex return. Many times while talking of the financial planning, while talking of the investment management, we have talked that basically there are 2 major stock exchanges in the country. If I talk of equity, right, the National Stock Exchange and the BSE. National Stock Exchange, the index of the National Stock Exchange is called Nifty, and the index of the BSE is called as Sensex. So in a period of time or over a period of time, how much return the Sensex has given. When I talk how much return the Sensex has given, Sensex involved 30 companies. So on an average, if a person has invested in these 30 companies, how much return in a particular period, say 22-23, that is starting from 1st April 22 up to 31st March 23, what was the return in investment in the Sensex companies? Those 30 companies, if an investor has invested, say for example in an index fund, in a mutual fund, there is a fund called index fund, where in the index fund comprises of all the 30 companies that are there in the BSE Sensex, right? So if you have invested in the BS index fund, what is the return which the investor has got, right? It must be equivalent to the return of the Sensex companies. And an investor invests, suppose, in a Reliance company, Reliance Industries Limited. So supposing the return of the in 22-23 is say 10%, and the investor who has invested in Reliance Industries Limited, the return is 12%. So, or if you compare the return of a particular company, say Reliance Industries Limited or any company for that matter, and the return of the Sensex over a period of time, if the return of that company's, when I am saying return means return of by investing in that share of that company, is greater than the return of the Sensex company, I will say beta is more than 1, right? So the beta is more than 1, it is high beta share, there is a high risk involved, the volatility is high, so the return is high. So it means, as you know, the return and risk has a positive correlationship. When the return is high, the risk is also high, and vice versa. I'll be explaining it in detail. So what is systematic risk? How you measure a systematic risk through beta? This is a subject of discussion. So beta is a measurement of volatility and indicates how much risk is involved in an investment compared with the market index. The point I was referring, that is basically Sensex or Nifty. Market index is nothing but Nifty or Sensex, or if you are talking in terms of any asset, right, any other asset class, say for example real estate. So there is an index of, say for example, real estate. So if that index, what is the return in investing in that real estate, where all geographical locations are involved, and you have invested in a particular real estate, right? So what is the return and what is the volatility of the return? This you can measure through beta. So beta is a measure of volatility and indicates how much risk is involved in an investment compared with market index. It is a number which shows whether a security is less sensitive or more sensitive to the market return. It means if a security gives you higher return as compared to the market return, I'll say it is more sensitive. If the security gives less return as compared to the market return, you will say it is less risky, it is less, involved, there is a lesser risk involved in that asset. So it measures systematic risk which is common to all the firms in the market. The beta for a portfolio is simply a weighted average of the individual stocks betas in the portfolio. You can talk, normally we talk of the beta of a particular security, but we can also talk of the beta of a portfolio. Portfolio consists of many companies. You have portfolio of 10 different companies, right? So it is a weighted average of the individual stocks beta. So that will give you the beta of a portfolio. How you calculate beta? Beta is equal to percentage change in the price of stock for a given period. That I was saying that in the 2022-23, what was the percentage change in the price of a particular stock? Over a period of 1 year, what is the variation in the stock price of that period? Divide by the percentage change in the market index for a given period. That is, what is the variation in the index? That is, how much index has gone up or how much index has fallen. The variation in that, the percentage change in the index, whole of the index, that is starting from 1st April 2022 and up to 31st March 2023, how much index has gone up or how much index has fallen. That is the percentage change in the market index for a given period, right? And the numerator, you have percentage change in the price of a particular stock. So in this way, you calculate the beta. And people do invest in those companies where the beta is high, because those especially who want to take more risk, they invest in such companies where the beta is high because they can get higher return. But nevertheless, the risk involved in that investing in that asset is also high. So the beta coefficient is calculated by relating return from securities with the return of the market. When you call it beta, means we also calculate beta coefficient. Is calculated by relating return from the securities with the return of the market. Beta indicates how risky an asset is or a stock is if the stock is held in a well diversified portfolio. So how do you interpret beta? If beta is less than 1, the security is less responsive to change in market return, stock is less risky than the average return of the market. Like if I take practical example, most of these PSU companies, public sector companies, of late, although the scenario is changing, but traditionally in India, PSU companies, they are high dividend paying companies. There are many good companies which are high dividend paying, but their fluctuation in the price of these shares is less as compared to the market fluctuations, right? So these companies are normally less beta companies. Like for example, again I will take the example of pharma sector, right? So pharma sector in India traditionally, situation may vary from a period to period, But if you take the example of last 20 years, 30 years, 40 years, you will find the stock prices of pharma company varies less as compared to the total market. So we normally say the pharma companies, especially the large pharma companies, the multinational pharma companies, and in India, the large pharma companies, they are less beta companies. They are considered to be less risky because their fluctuation in the return of these stock prices of these pharma companies, which are of very large multinational companies, is less as compared to the market, right? So those companies which are having less than 1 beta, they are being considered as less risky, right? Companies which are having high beta, if beta is greater than 1, the securities is more responsive to the changes in market return, the stock is riskier than average. Normally over a period of time, again I will take the example of equity market, these small cap shares, small cap companies are those companies which are not having very high market capitalization, right? They are having less market capitalization. And what is market capitalization? Market capitalization is the number of shares in the market, that is the number of shares that is floated in the market, multiplied by the current market price of the share, is called market capitalization of the company, right? So those companies which are having low market capitalization, they are considered as small companies, right? So normally what you will find is this small companies, they are having high beta because these companies are more responsive, more fluctuates more whenever there is a change in the market. Suppose market comes down, it has been observed that the prices of these small companies fluctuates more than the prices of large company. Prices means stock prices. So these are called high beta company, means the range in the fluctuation the prices is very high. So they are considered as the high risk companies. Their beta is more than 1. So the securities with more responsive to the changes in the market return, the stock is riskier than average. If beta is 0, in practical life you don't find 0 beta, right? It is not responsive to the change in market return. Practically, by and large, it's not possible in the long run that the beta becomes 0. Whenever there is a market change, there is some response, some changes in the price of the particular stock also. That's why I say it is difficult. But theoretically, you can say if the beta is 0, it is not responsive to the change in market return. And if beta is 1, right, it means the security return is equivalent to the return of the market. Return of that particular asset is equivalent to the asset class. If I was talking of real estate, means if you have invested in a particular area in a particular real estate and the price of that property fluctuates as per the overall real estate market in the country, then you will say beta is equal to 1, right? So this return of the beta, where the beta is 1, it means the return of the security, return of the asset is equivalent to the return of the market. So this is the way you interpret the systematic risk in terms of beta. Now, after talking of risk and the methods of measuring risk, let me briefly talk about risk-adjusted return. It is a concept which is used to measure an investment return by examining how much risk is taken in obtaining the return. That is, or I will put it this way, for each unit of risk taken, what is the return? That is called the risk-adjusted return. The purpose of risk-adjusted return is to help investors determine whether the risk taken was worth the expected reward, right? So, an investor who is ready to take higher risk, but he expects higher return also. That because there is a positive correlation between risk and return, right? So when the risk increases, the expected return also increases. When the risk is, like if you talk of various asset classes, like we say, why do people deposit in fixed deposit? Why do people deposit in post office? Because the risk is very low. Risk is almost. Why do people deposit in treasury bills? Treasury means government securities, bonds, government bonds. Because they know that the risk is almost 0. So they are even happy with 6%, 7%. I am talking of the current scenario. If the rate of interest in the market is 6%, 7%, and if the RBI bond is giving you 6% return, you are happy enough. But when you invest in the equity market, when you invest in the real estate, when you invest in gold, you will not be satisfied by investing in gold or in real estate or in equity if the return is 6%, because return fluctuates. So you are not very sure that the expected return will be 6%, or it may be 16%, maybe 20%, maybe 30%, it may be in minus. So what you are doing is you are taking risk while investing in that asset class. On the other end, while investing in bank deposit, fixed deposit, PPF and treasury bills, you are not taking any risk. The government of India assures you that this much return will be given to you, right? So for that matter, any time any investor in any asset class, if he or she is taking risk, then the certainly like high return also. So for that very purpose, we calculate risk adjusted return, that how much risk, how much return the investor is getting for each unit of risk taken. So there are methods of measuring these returns, risk adjusted return. We call it Jensen alpha, beta, Sharpe ratio, Trainer ratio. Basically, we talked in terms of alpha, Sharpe ratio and Trainer's ratio. These measures are helpful in comparing various individual securities and portfolio. What is Jensen alpha? So it is simply the measure of an investment against a benchmark index such as the Sensex Nifty based on systematic risk, right? So as I was saying when I was talking in terms of the beta, that you compare that the fluctuation in the prices is whether more or less than the fluctuation in the market. That is how you calculate beta, right? If fluctuation in a particular share is higher than the fluctuation in the price of Sensex or index, right, you can say beta is high or low. Similarly, for calculating alpha, that is, you are finding out whether the return provided by that in portfolio is, or by that asset, is more than the market return or less than the market return. So it can be calculated as Jensen alpha is equal to portfolio return minus risk-free rate of return. Risk-free rate is, as I was talking, that risk-free rate, which is risk-free rate of return? Risk-free rate of return means if you invest in that asset or in the particular financial asset, there is no risk involved. I was saying just now that treasury bills, the bonds issued by the RBI, that is on behalf of the government of India, it is RBI which issued the bonds. 10 years government of India bond at present, say for example, give you 7.2% or 7% return. So at present, I'll say the risk-free rate of return is 7%, because it is the government of India which is promising that, or I can say it is the RBI which is promising that on their 10-year bond they will give you 7% return, right, or 6% return. So that is called risk-free rate of return. Or for that matter, even you can say large public sector, commercial bank, SBI. But friends, let me caution you, no asset is 100% risk-free. Even investment in banks is not 100%. I am presuming that the government never fails, especially in a sound government like India. So I am presuming whatever the rate of interest RBI promises to give us, that is basically risk-free rate of return. So that is basically the benchmark rate of return, which we can say as a risk-free return. So Jensen alpha is equal to portfolio return. If you invest in a portfolio, what is the return you are getting, minus risk-free rate of return plus portfolio beta, right? That is what is portfolio beta into market return minus risk-free rate, right? So what you are doing is, if you use this formula, you will get Jensen's alpha. Once again, let me tell you, portfolio return minus the risk difference between the risk-free rate of return and the plus portfolio beta into market return minus risk-free rate. So that will give you Jensen's alpha. If Jensen alpha is positive, the portfolio has outperformed the market, whereas negative value indicates underperformance. Every portfolio manager wants to create some certain alpha. We say, how much alpha have you generated by investing in that portfolio. That is, if you're getting a return, simply putting it this way, if your portfolio has given you a return which is greater than the market return, we say you have generated alpha. You have generated positive alpha. If the alpha is positive, if you use this formula, you will find whether the alpha will be positive or whether the alpha is negative. If you find that the alpha is positive, it means portfolio has outperformed the market. If alpha is negative, it means you have underperformed. Say market has given you 14% return, but you have got 10% return. It means your alpha will be negative. You have given 4% less return as compared to the market return, right? So alpha will be negative. Every portfolio manager, every individual who invests in a different asset class and make a portfolio of different assets, want to generate certain alpha out of it, right? So Genscher alpha is a good measure of measuring risk. If alpha is less than 0, means the investment was too risky for the expected return, means when the alpha is negative, investment was too risky for the expected return. As I was saying, risk adjusted return is for each unit of risk which you have taken, how much return you expect, right? So if alpha is less than 0 means negative, it means the investment was risky. Alpha is 0 means the return earned is sufficient for risk taken. If alpha is greater than 0 means it is positive, it means the return earned is greater than the assumed risk, right? So every portfolio manager, every individual wants to create an alpha which is positive, which is greater than 0. If you get an alpha 0, it means you are getting a return as the market return is there, right? So whatever the risk you are taking, that is, it gives you equal return than that the market return. Other method is called Sharpe ratio, right? Other method of risk adjusted return is give you risk adjusted return is measured by Sharpe ratio. Sharpe ratio basically measures how much return an investor receives in relation to the level of risk he is willing to take. When I say he, it's involved she also, right? So anybody, any individual, he or she or transgender, anybody, any human being who invests, right? So how much return that investor receives in relation to the level of risk, that is measured by Sharpe ratio. It is a measure of excess portfolio return over the risk-free rate relative to its standard deviation. So standard deviation is a measure of risk which we through measure. So any excess portfolio return we are generating in relation to the standard deviation of the risk-free return, that is known as Sharpe. By that way you can calculate Sharpe ratio. So ratio evaluates the risk in terms of standard deviation, which is a measure of total risk. In the previous lecture on risk, we talked about the standard deviation and we talked about other measures, but by and large standard deviation is the most popular method of measuring the total risk. So it defines the risk if broader way than Jensen alpha and Trenner ratio, which is based on systematic risk, right? So friends, systematic risk, the risk adjusted return is being calculated by Sharpe ratio. So in this Sharpe ratio, how you calculate? Return on the portfolio minus risk-free rate, right? Divide by standard deviation of the portfolio. That is, first of all, you will calculate how much return the portfolio has given minus risk-free return. Risk-free return means, as I was saying, the rate of interest on the treasury securities is called risk-free return. Your portfolio has got the 14% return. Risk-free rate is 7%. So the difference of 14 and 7% is called the difference between the return of the portfolio and the risk-free rate. Divide by standard deviation of the portfolio. Means what is the degree of risk we have taken to get this risk, to get this return. And this way you will find out Sharpe ratio. So higher Sharpe ratio, once again I am repeating, the difference between of the portfolio and the risk-free return divide by the standard deviation of the portfolio. That will give you the Sharpe ratio. If higher Sharpe ratio is there, means higher return due to good investment performance with a good level of risk. You have assumed risk, but providedly you have got higher return, because risk will be measured by standard deviation. In the denominator you have taken risk, in the numerator you have written that how much extra return you have got over and above the risk-free return. Right. So risk-free return, why to take tension, why to take any risk? Because if the 7% is the risk, if I want to earn 7%, I will simply invest in treasury bills, I will simply invest in post office, right? So this is my risk-free return. If I am investing in gold, if I am investing in real estate, if I am investing in equity, certainly I would like that I must get some extra return than the risk-free return. But it should be related with my risk of that which I am assuming. So that risk is being calculated by standard deviation, is measured by standard deviation. So the difference of the portfolio return and the risk-free return divided by standard deviation will give you Sharpe ratio. So higher Sharpe ratio means higher return due to good investment performance with higher level of risk. And finally, just very quickly, Turner ratio. The Turner ratio is an extension of the Sharpe ratio. It measures the return earned in excess of what could have been earned if the investment did not have any diversifiable risk, right? So it uses a beta coefficient instead of the standard deviation used in the Sharpe ratio. So what you find is in the Sharpe ratio we have used the standard deviation. Instead of standard deviation, what we use is that in this Turner, right, we have used the beta of the portfolio, return of the portfolio minus risk-free rate divided by the beta of the portfolio. So Turner ratio requires positive numerator to give meaningful comparison result, and it does not work for negative beta assets. So means that when the beta asset is positive, right, then you will calculate Turner ratio requires positive numerator to give meaningful comparison. Right. So thank you very much, friends. So in this way you can calculate risk adjusted return, and we have discussed that how you calculate risk by measuring different methods in our previous lecture, that is the range, standard deviation, variance, coefficient of variation, and in this lecture we have talked about different methods of measuring risk adjusted return, right, and other things about the risk. Thank you.